The near-term stresses, challenges that you sort of did speak about, many point out to the NPA problem, which are holding banks from financing the next boom or the next sort of, leg of spending, so as to speak. Is that challenge number one in your assessment?
Not really. I'll tell you very candidly that the stress in the Indian banking sector is overdone by all kinds of, brokers, and they are like, they're bearish on the Indian market. I don't know why, because the underlying story is like very, very attractive. But the fact of the matter is that we have some stress. We have mid-market, stress in the economy. The big groups have the ability to bail out because, they have strength of assets. They have the ability to revalue their assets. So the replacement value of the assets of the larger groups in India is far exceeds the replication cost, far exceeds the debt on their balance sheets. It's just that they need to find an opportunity to be able to monetize and de-risk a part of that. That will happen through strategic partnerships. It will also happen through, at the right time, capital raising. So I think the stress in the Indian banking sector is maximum 12 months of de-stressing. And there is a lot of intense focus on that. And I think, by and large, India will have a soft landing.
And you are linked to some of the chronically stressed large corporate groups, which you think over the next 12 months will be able to sort of pass through this challenge.
I'll tell you a secret because I'll tell you a secret because I'm in this business for now 36 years, focus on my country, India, that the big guys, they have the assets. They have the ability to be able to churn and create velocity in the assets to find the right investor. It's actually the mid-market guys and the SMEs that go through the, stress. It's how we create, a soft landing for those sectors, which I think is top of the mind with the new government. And I'm very convinced that India, March 2017, so we're talking about 15 months from now, will have a soft landing. And to me, that will also be a turning point for credit growth, for overall, more FDI investment and more ever FII investments, which our country needs, and retail participation. We need that as well.
Retail banking still is doing very well, right? I mean, demand for home loans, auto loans, that remains pretty solid. It's a large corporate exposure, which is a cause of concern. And you're saying very clearly to investors that the bearishness on Indian banking sector is completely overdone.
I think it's overdone to the extent that, as I mentioned, that we have the ability to cushion the shocks. We have the ability to make sure that we have a soft landing. And overall, if I see that the larger groups have a lot of intrinsic asset values in the business, right? As I mentioned to you, the mid-market guys
which feel the stress, and the smaller guys.
Which feel the stress. The smaller guys feel the stress, and the banking system has to naturally look after them. They're also well collateralized, they're well secured. So it's not like there are a lot of missing gaps, Number two, your point, how do we take off the economy? I think we have to understand one thing, that India needs right now 2 or 3 growth engines. We discussed how to get the stress out of the banking sector. Number two, how do we create an environment which is going to create new expenditure, public expenditure, capital expenditure, which is going to stimulate new growth, and also public and private, in a way, revival. And I think that second step needs a little acceleration. And I'm very convinced that we also need real rates in our country to be a little lower.
I'm going to be slightly specific, not too specific. The total stressed assets as a percentage of bank assets is about 14% or so. Restructured is another 6%. SDR 525 is another 3-4% or so. The worry is, no one knows what to sort of write off. Is it 10% of these, 15% of this, 20% of this, which is not coming back? And what is the impact of that on net worths? That's the reason why markets are so bearish about bank stocks right now. In your assessment, from what I heard so far, you're saying, the large guys have the ability, so you should not assume very large numbers as write-offs, right?
So I fully agree with your observation that India will have a gentle, overall. We have safety nets in the system.
Okay.
And yes, we are looking at, a situation where there has been NPA precipitation in our economy. But I'm deeply convinced that this is not going to be like a super shock in the system, that because of intrinsic value of businesses, as the economy starts picking up, as interest rates start coming down, the consumption story is very compelling in our country. More FDI starts coming in, FII gets revived with a little bit of a lag now, and retail participation in this budget is very important to get retail participation, to get the savings propensity in the economy going. Not just bank savings and debenture savings, savings in equity markets as well as in the mutual fund markets. I'm very, very convinced that this budget will have a lot in store, because at 30% savings propensity, we are 6 to 6.5% less than we were in 2008, 2009. And a good economy which needs investment and capital formation needs the economy to have at least savings of 45%, which Japan and China demonstrated during their heydays.
Interest rates, you think we'll see a cut before the budget, or maybe just a roadmap would be helpful? What's your expectation?
Candidly, that I think there is a very compelling story here again, that we look at CPI, and I am very convinced that CPI is also a very important factor. But when you look at WPI hovering between minus whatever 3-4%, and then you look at a middle factor, the middle factor is the GDP deflator. So when you look at the GDP deflator, you'll recognize that today is directionally the most important factor in determination of interest rates. So I'm very convinced that we should look at least 75 basis points repo correction. We should look at bank rates coming down quite gradually and steadily. Once the credit costs go away from the banks, because they're also bearing credit costs and therefore transmission is sluggish in that respect. But I'm very convinced that we have a very, very enduring case, very sustainable case for lower interest rates.
The Finance Minister yesterday in the NDTV session pointed out, he seemed open to the idea of increasing government spending. So in the budget, that's the need of the hour, even if that means not contracting the fiscal deficit this year, right? Government spending is the need of the hour, number one priority. Would you say that?
I would 100% agree with the Finance Minister in London, and yesterday also at your session, NDTV session, he was very committed to ensuring that public expenditure, capital expenditure as in productive expenditure, which to me tantamounts mostly to infrastructure investments. Because to me that is the most important driver in being able to create multipliers in the economy, because that also de-stresses the economy and it also multiplies the economy. And I am very convinced that the Finance Minister's inclination, directed by our Honorable Prime Minister, that capital expenditure in the right places at the right time will happen in calendar 2016. And I am very convinced that India is a very bounced back economy, maybe second half of the year.
Mr. Kapoor, pleasure speaking with you, sir. Thank you very much for your time. Thank you.
Hindi.